at this point now, I know you're watching treasuries and those yields to give you some sort of indication. How so? What is it that you're watching specifically?
So we had the best week in about a year on stocks with the S&P 500 up close to 5.9%. But, that was all driven by the movement in the 10-year Treasury. Remember that 10-year Treasury briefly got above 5%. That was a 16-year high. And then at one point it dropped all below 4.5%. So that was really driving stocks. So I'm telling my clients, if you can forecast interest rates, I think you can forecast markets. And that's why I think we're seeing a little backup here today as we've seen the 10-year Treasury retrace some of that drop.
Right.
It was due to retrace some, so I'm not concerned, but that's what we're looking at.
So when you look at the 10-year, right, what's it at 4.65? I mean, there was talk about going above 5, above 6, even to 7% on the 10-year Treasury. Where do you think Treasury yields are most likely to go? More near term and more long term?
So I think, when you're at a 16-year high, there's the most powerful trend in finance is reversion to the mean. So I think it goes back, and there's good fundamental reasons why. One, of course, is inflation. We've seen, for example, recently that year-over-year core inflation rate got down to 3.7%. That's about a third of where it almost was about a year ago, and all signs suggest that it's going to go down lower because unemployment, we just on Friday got that unemployment rate, it ticked up, plus there's a lot less jobs creation. So if inflation comes down, we think interest rates are going to come down and the Fed is going to follow suit.
Right, understood. Okay. In the meantime, I know that you have people at PPAC Private Wealth Management. You said your clients, you check in with them and they're calling you. We see things on television. For example, Morgan Stanley saying this is probably more likely a bear market rally based on earnings, weaker earnings revisions and macro data. So they're feeling more bearish. Then you'll have someone like Ed Yardeni's team saying, look, the market the correction is done, that's over, and now maybe we'll head back towards 4,600. Where do you think we're heading? I mean, what do you tell them when your clients call you and say, oh, I saw this and I saw this?
Well, we definitely avoid trying to make a short-term call. We try and stay diversified.
Yeah.
But here's several reasons why we think you should still continue to tilt towards stocks. One is earnings. Earnings are expected to be up 12% next year. Indeed, after a lot of pessimism over this past quarter's earnings, it looks like this is going to be the first quarter in 4 where year-over-year earnings are up. So corporate earnings are moving in the right direction. We've also got some strong seasonal factors here. November historically averages up 1.7%. It's the strongest of all 12 months. We're in the middle of November, and the November-December pair is extremely strong. So those are several reasons why we think things are going to be better. Another bank just recently said that their private market accounts are showing a big overweight now to cash, 16% in money market versus the normal 13%, and stocks has flipped to just 58%, down from a recent 66%. So we think that actually the average investor is overweighted to cash. As those yields start to come down, money markets, they're going to say, hey, let's rebalance into stocks. They're going to start look at the margin like a better deal.
Right. At this point now, I wanted to get to some of your picks. And I know you have a different group here. You have a bank, you have healthcare, and oil. Let's start with Bank of America.
Yeah, absolutely. So, of course, the banks and financial institutions have been crushed. There's nothing worse for a bank than having to pay more for their deposits, particularly when what they're having to pay for deposits may be less than what they've already lent the money out. So, on the other hand, banks have reflected it. It's the worst performing group. They're down about 21% year to date, even though the overall S&P 500 is up nearly 10%. So I'm looking through all these names and looking for what are the first-class brand franchises. I keep coming back to Bank of America, coast to coast. They have one of the largest group of insured deposits, which means they're very low-cost deposits. They've gotten some bad press because, of course, a lot of their longer-term holdings are underwater because of the higher interest rates, but we think they are going to be held to maturity. They're going to make that up. I like Brian Moynihan, the leader. I think he does a great job.
Right.
I love the Warren Buffett / Berkshire Hathaway sponsorship. Normally, the yield on Bank of America is about 2.4%. Right now, it's about 3.7%. The PE is down to 7, and they're very close to book value. So you're getting a blue chip, world-class franchise at basically book value. What's not to like?
Right, understood. Okay, and next up, the one we teased, Chevron. I'm curious to hear where you think oil is going too. Chevron is your pick, and where do you think oil is headed?
We think longer term, oil prices are going up, and here's why. We think that the transition is going to take much longer than people expect or hope for in terms of a greener world. So in the interim, demand stays constant, but supply, where's supply going? Well, the problem is everyone's afraid to drill for more oil because they read the headlines that the government's going to, force people to shift to this green thing and that green thing, and therefore supply is going to be lagging. In the meantime, how do you reconcile low supply with still strong demand? Higher energy prices. I think that was underscored by both of the key majors, both Exxon and Chevron, making really blockbuster acquisitions. Pioneer, the biggest acquisition for Exxon since 1999, and Hess, of course, a huge $60 billion acquisition, a part of Chevron. They're putting their money where their mouth and their belief is, and I think, who knows better about the industry than those two large super majors?
Right, and so do you like Exxon too, or Chevron really is more of the standout, obviously, for you?
We do. I think Chevron, you have a particular opportunity here. It's down 17% year to date. Exxon's only down 2%. The energy ETF is flat. Why is that? They did have a bit of a third quarter miss where one of their fields in Kazakhstan is going to take a little bit longer to get fully engaged. And of course, people are still trying to analyze the big acquisition of Hess. We think it makes sense because they're going to have a large position in these great fields off the country of Guyana. That's away from the Asia theater and so forth. And of course, I have only great respect for Michael Wirth, who's the head of Chevron. And of course, remember the tradition that Chevron has. This is a dividend aristocrat. That means they've raised their current 3.7% dividend more than 25 years in a row. At the same time, they're buying back shares. So they're going to ultimately, we believe, deliver 10% per year shareholder return. And of course, the stock is trading only about 11 times earnings because it is down 17% year to date.
All right, and last but not least, CVS.
The pharmacy business is a tough business here because they've got the opioid litigation. They've got the 800-pound gorilla Amazon pharmacy staring down their necks. But we think CVS, between it and Walgreens, is the one you want to have. First of all, it's really three different companies. We got the retail pharmacy, you've got the PBM, but also Aetna, which is their health insurance company they bought a few years ago. They have the highest margins of those various divisions. CVS, too, is a dividend aristocrat. There's a theme here, right? Raising those dividends for more than 25 years in a row. You've now got a 3.7% dividend, better margins than Walgreens. And finally, I think people haven't fully recognized what the Rite Aid bankruptcy might mean. Where are those Rite Aid customers going to go? Well, CVS has their hands raised, and they may even be able to take over some of those stores. That could give them an additional tailwind here.
Very interesting. Good point. David Dietze, always love when you are with us of PPAC Private Wealth Management. Thank you so much for being here, David.
Thank you, Nicole.
And your picks.